Thanks so much for tuning into this broadcast. We are at 14,000. So let me tell you, rattle off some statistics that we rattle off in the trade setup today as well. The best year since 2017, best quarterly performance since April to June period of 2009, and that's going some distance. First instance where the Nifty has had three successive quarterly gains since 2014, and we are not done with the day as yet. Well, let's get in somebody who's looked markets extensively over the years to talk about the Nifty at 14,000. Ajay Bagga joins in with his thoughts. Mr. Bagga, good having you. Thanks for joining in. I don't think too many people anticipated at 7,500 that we are at 14,000, that we would be at 14,000 in the current calendar. But now that we are here, what's next?
Yeah, Niraj, first, I think very much all of us welcome this move being as investors. Huge learnings in 2020. It has been a very deep correction, but the fastest coming out of the correction as well, the fastest recovery, very deep economic recession, and a very fast recovery for that. Normalization has not happened. A lot of 2021 is baked into the markets at present. 30% plus recovery in earnings is anticipated for 2022 these markets right now. So that's why they are not scary at the price earning multiples they are, because it's more looking back is looking forward is the recovery from that. So overall, I think the first quarter might be a little challenging on the basis of the further spread of COVID. We have a little event in the US with the Georgia elections and then the electoral vote counting, which both should go by, but it's a little binary as far as the Senate majority goes. So markets direction might come from there. Third is that in the first year of the presidential inauguration, normally 8 out of 9 times the markets, US markets have gone up about 10% on average. But the first quarter normally is subdued because new policies and a lot of uncertainty comes in. So let's see how that works out. But looking at India, flows have been very strong November, December. We anticipate those flows to stay. Our expectation, Niraj, for central bank monetary stimulus next year, as against $8 trillion this year, we are expecting $5 trillion at the minimum. Right now, if you just do a back of the envelope calculation, starting from 120 billion a month from Fed and 80 billion from the ECB, and you add it all on, you're looking at something in the range of $300 to $350 billion a month of monetary stimulus continuing. So that should keep the markets elevated and help the markets recover. Is there froth in certain areas? Yes. Yes, Niraj.
There is no. So I'm just laying this out on Twitter and on YouTube, at least the two platforms that I have very easy access to. I might take a couple of questions if you have for Ajay Bagga,
Yeah,
so
sure.
please feel free to send me. But nevertheless, a few questions first. We don't need the market to do dramatically well, right, Mr. Bagga? We've established that large caps have done their bit, and maybe it's the turn of the broader markets and value stocks to do well. So even if the indices don't have a large correction, they stay put or just increase marginally, would there be a bull market in the non-Nifty 50 names, in the value space, in the non-participative space, or even in the spaces which have participated but are going to show strong earnings? They may not have an impact on the Nifty, but they may do well.
Yeah. If you had asked this last November, December, and if you had said that, will you take 14-15% return from the markets next year, all of us would have been happy. If anyone got the timing right in March or even in April and invested, and they are sitting on 50, 60, 70% returns, they would be the most happiest people. But overall, if you see, on a 10-year basis, our small cap has given nearly negative returns, marginally negative returns as of a couple of days back, and it's not done much in the last 2 days. Mid cap has been marginally up. Nifty has barely managed to give you 100% return. So we are coming, and these are rupee returns. If you look at dollar returns, we'll be in negative territory on a 10-year basis. So we are coming off earnings disappointments for last 5 years, a very big NPA problem, and third, markets having underperformed. Now, what changes? The big change is the global liquidity, of course. Second, the hunt for yield. Today, Neeraj, one third of the total bond issuances in the world are in negative yield. And if you take the real interest rate being negative, then it's a much larger scope than even that $18 trillion of bonds which are at negative yield. So that carry trade is going to really rush into the emerging markets. Third big thing is the dollar weakening. We are anticipating the dollar to go down further in 2021, which is normally positive for emerging markets, positive for industrials, metals, commodities. Fourth big thing is the commodity to equity ratio. That is now down at levels last seen in 1987 or 2000 at the dot-com time. What that is showing, equities have discounted the future much more smartly, while commodities have been seeing a lot of pain over the last 3, 4 years, even though metals have recovered somewhat this year. But on a historical basis, commodities are still underperforming. All that will lead to, I would say, the smartest strategy today, given the information we have today. You have to stay in the growth segments because they will continue to grow. The recovery trade will take time, maybe 6 months. The recovery plays will start showing up. They have already started, but on a 1 year basis, they are still uncomfortably low. But the financials, the aviation, the transports, the energy plays will start picking up sometime down the line. So you have to have a combination of both the growth segments, which did very well in the work from home scenario, and which will be digital beneficiaries. There's a whole slew of IPOs lined up in India also, from the
Yeah.
Zomatos to all these players, and you have to participate in that. But I think there will be a shift to cyclicals, there will be a shift to industrials, financials. That will happen gradually. Uh, Whether you take the position now or you wait for more clarity, that will really determine your entry point then. But I would say it's a barbell strategy between growth and value both. Value, I'm not very sure. In September, it looked like value will come back very strongly, but last 1 month, the tech shares have really caught up again, and value has been pushed back.
But, but you also have to admit, Mr. Bagga, that at the same time, while tech and pharma, etc., all have done well, amongst the best performers from the March lows has been metals. So people did chase to an extent some bit of value too. What happens to those spaces? Commodities, let's say, metals and some of the others.
No, there is a lot of runway. There is runway to increase. As I said, commodity to equities index that we track is at historic lows. And normally at that point, there's a market correction and commodities tend to do well. Market correction might not happen this time around because we have so much liquidity, and that is chasing risk assets. But commodities will do better next year. That's our feeling.
Okay. Well, I'll squeeze in a few questions that come in. One question that has come in is will Reliance do well now? Now it's almost a sector in itself. So I want to ask you to comment on the stock price performance, Mr. Bagga. But yes, the poster boy of fund flows into India has been a bit quiet off late. You have to admit, it's got in a bit of a hibernation mode. Uh, any thoughts? Don't give a target. Don't give a buy or a sell recommendation. But any thoughts on what Reliance could do?
Yeah, if you look at, I always say on the e-commerce side, you should compare Reliance to an Alibaba, for example. Though we are late, India is about 10 to 12 years behind China, but we will catch up. We'll leapfrog stages. And Alibaba at 800 billion versus Reliance at 170, 200 billion. There is a lot of runway. There is a lot of catching up to do on a multi-year scenario. So now a lot of execution will matter on the e-commerce, on the digital, and on all their tie-ups, the Facebooks and the Googles and the WhatsApp, all those getting integrated. The 5G rollout, that will be another game changer. So a lot of drivers for the stock. When will it start performing again? It's 2,300 odd, and since October, and the stock went into a bit of a consolidation mode. Multiple drivers are there on the new economy side, and then there is the huge retail, Reliance Retail. They are the biggest retailer in the country. So those things will now determine the way ahead. But looking at the Chinese example, which is similar in terms of the population, and India has more traction on the consumption side and more traction on the tier two, tier three cities picking up on the e-commerce side. So if they can get their formula right on this, and while competing against the world class Walmarts, Amazons, Flipkarts, if they can get that formula right, then you're looking at an Alibaba kind of a valuation a few years down the line. So that way, the stock is recommended, but I would not say buy or sell, or I would not
Of
try
course.
to make a price. Yeah,
Yeah, of course, of course. That goes without saying.
yeah,
A couple of other pockets which are in current news, Mr. Bagga. One of them was this data that came out which suggested that the property registrations in Mumbai have gone through the roof. So now it's very easy to get caught in believing that pent up demand is actual demand which will last. What's your sense? Is this pent up demand only, or is this something more than that? And therefore, is there merit in trying to own any of the listed real estate plays? I mean, whether it's Bombay specific or otherwise, but because of the upsurge in real estate sale.
yeah. On real estate, I would say you have to stick with quality, stick with the low leverage plays.
But you
This
would stick with
demand,
it. You would be
sorry.
comfortable buying. You would be comfortable investing in real estate.
Yes, and I'll give you the reason. Commercial real estate don't touch. You see San Francisco, New York, the way rentals are coming down, and all the shared office space companies also one doesn't know. So the private equity will absorb that supply for some time, but we don't know. So commercial, no. Residential real estate providers with low leverage. I think that's the mantra. One thing behind the numbers, Niraj, still the year-on-year numbers for the full 2020 calendar year will be 40 to 45% below 2019. So this is more a stamp duty effect. This is very anecdotal information that I'm sharing, from my circles. I have people who have lease rental discounts working, and they had surpluses of rental coming in. They are looking to buy more residential property because fixed deposits rates have gone so low, and mutual fund liquid schemes are giving hardly 3%. So there is some amount of shift. Again, that in a asset liability maturity mismatch doesn't make sense exactly. But people are just saying that why should I put money in a financial asset at 3% when I have an upside possible on the real estate? That is one.
Hmm.
Second is the stamp duty concessions that the government did. I'm seeing very big, a lot of lawyers I've been talking to. People are just trying to register the property, save that 4%, 5%. That has been a driver. Real prices have not come down so much, from say 6 months back to now. Prices are not
Hmm.
really down. Luxury segment is a very different segment. That's 100 flats a year. the Motilal's buying 100 crore flat and all that. That's different. This is actually ready properties which people are registering or to be ready over the next 6 months. So it could be fulfillment of a lot of the 2021 registrations to avail the low stamp duty. So I would not mark it as a trend, but real estate will do well because it's coming off a multi-year cycle. But this year numbers are going to be 40% lower year on year. This is a misnomer that in the last 3-4 months numbers have picked up. But look at the April to July numbers. April and May, hardly any registrations.
Yeah, that's true. That is true. But just credit to select governments, state governments as well, which kind of gave some booster measures in order to try and prop up these, because multiplier effect is just so strong. Okay, now viewers, the other thing is, let's just get to this chart of the Nifty main contributors in the last 1,000 points from 13,000 to 14,000. We all know it took about 25 or 26 odd sessions for this to happen. So this 8% gain that happened from the 23rd of November until now has had seriously expensive Asian Paints gaining another 25%, has seen some value stocks in ONGC and GAIL India come back to flavor as well, as is State Bank of India and L&T, but has also seen the participation of laggards like Sun Pharma, because Sun Pharma was the laggard pharma stock, and that has done really well. But at the same time, we've seen some PSUs and some high-flying stocks, particularly Shree Cement, for example, take a bit of a breather in the last 1,000 points. So, well, food for thought. The last 1,000 points have seen some very interesting moves out here. SBI, ICICI Bank, few banks out here, and there's a question, Mr. Bagga, that is coming from Ankit Kumar Mishra. He asks that have the banks, especially the PSU banks, provisioned enough? Because the RBI's comment is that there can be a sharp increase in the NPA. I guess the answer is that maybe the provisions may not be enough or maybe enough, but give me a sense of that and give me a sense of whether the market has discounted the fact that there will be high provisions, or could there be gashes in the market valuations of some of these stocks if indeed the provision numbers turn out to be very high.
Yeah. See, again, it is a black box. And earlier, if you remember, in April, there was a huge sell-off in the banking pack because we thought that by September, the NPAs will really spike. So between the Supreme Court case and then RBI asking them not to recognize till the case is finally disposed of, we have not really seen the full NPA recognition. The good banks, including public sector banks, have been giving a number that if the RBI and the Supreme Court case was not there, this is how much we would have actually recognized. That was not a fearsome number. So based on that, we saw from a minus 25%, we saw the bank Nifty climbing up again from November. And if you see the FII money, the large portion was going into banks and NBFCs. So people have said that the worst is behind us. That's what the market is discounting. Now, talking of NPAs, Niraj, the IBFC process was put on hold. So we have not really gone ahead on that. And till now, also, the process has been largely slow. Recoveries have not been that hot. So it's been better for banks to sell off to ARCs and take an IOU from the ARC rather than wait for the IBC process to come through. What will March bring once the Supreme Court ruling is in and recognition starts? How bad will March get? Normally, this trends in banking report will be the conservative report from the technical experts in RBI. It's like the economic survey. If it was a utopian world and everything was great, this is what we should have done. I'm sure there will be a lot more, what do you call, accommodation given to banks from now to March to help them tide over this process. It's happening around the world. US has a countrywide no removal of tenants rule on, which just got renewed in this latest stimulus package. China has that. Whole of Europe has. A lot of Europe has
Hmm.
standstills on mortgages. So I'm sure the government and RBI will bring something. So, in a nutshell, am I afraid of the NPA issue? I don't think so. I don't think we have that big an issue because we have been providing for the last 6 7 years. Our public sector banks are by, I think, the top two three, but they have run up again in anticipation. So now might be a time to let them cool off. But overall, in India, foreign money is also buying financials, and stick to the quality. Don't look at the transformation cases. And quality, I will include the private sector corporate banks, which are turning around or have turned around already. Those are quality. Those are not poor quality. But lower down the chain, trying to find the next HDFC bank or trying to find the next Bajaj Finance and going down the value chain, I think that is fraught with risk. So there, maybe 1% of the portfolio you put it as a punt, and if it happens in 5 years, that's good. Otherwise, your other portfolio would have made up for the loss. But big money don't put in these transformation cases. There are enough uh, roadblocks, stumbling blocks. What we are hoping is that the government is very much seized of the issue. RBI has a very first-class governor and deputy governors who are looking at it, and the track record over the last 9 months has been of a lot of flexibility, a lot of moving on a dime, and being very pro the banks and safeguarding the banks. So that should help. Overall economic recovery comes, financials will do well. So that's a mega trend. So if you were a top-down macro investor, which a lot of the FIs are, they are betting on that, and there the public sector banks have huge shares. So the top three, four can be looked at.
Final question, Mr. Bagga. If indeed in the last 1.5 months or 2 months you have invested money into the Indian markets, let's say, what are the themes that you've logged into?
Again, as I said, it has to be a combination. I think the top three, four tech plays will do very well. Pharma will continue to do very well. Vaccine is not a one-time issue. So medical suppliers. Then you have the China substitution trade. Chemicals had run up a lot. They corrected, and now again they are going up. The broad theme on a decade basis, Neeraj, you had value in 1990 to 2000. Then you got tech coming in very strongly towards the end of 2000. Last 10 years, again, value has underperformed, growth has done well, but we can't shut out growth, especially in a country like India. I think all these startup IPOs that will come, that will generate a lot of funds, a lot of traction. Other issue is we are not seeing any margin issues. We are not seeing leverage issues. SEBI has been de-risking portfolios, and mutual funds have seen outflows. So HNIs are sitting on large pots of money. FPIs are sitting on a large allocation pool. We are seeing passive money coming into India, which leads to a lot of the quality top end stocks getting bid up. Small cap, mid cap, will they see traction? Again, we have to see quality there. I get very afraid because the junk starts moving faster. Then, moment there is a move in mid cap, small cap, you start seeing the so-called euphemistically operated stocks moving, which have no story or no fundamentals, and that then brings grief. So I would say diversified, quality, value comes back, but don't give up on growth. So maybe 50-50 between growth and value. Metals should continue to do well. Cement, home building material suppliers. Again, look at the price earning ratios. There are companies with 70, 80, 100 Ps, which making money from there will be very difficult. Or if you're smart enough to ride it and get out at the right time, then go for it. And big chunks money will come into financials, will come into durables, will come into industrials. Industrials is turning capital goods, budget. will be very important. There's already Bloomberg put out a study yesterday saying that the fiscal deficit will probably be
Yes.
8%, and the FM is saying they will overspend. So overspend will come back as consumption. So there you have to be in the durables, in the two-wheelers, in the consumption stories, all those themes, because it's a 65% consumption-driven market. And on the second end, government will put money into infrastructure, and funds will flow there. So the big infra plays might be coming back. That's a one-year theme. And the suppliers of finance to them. So banks will gain from the consumption, they'll gain from the infra, they will gain from the corporate earnings turnaround. So banks and NBFCs, again, quality top end, who don't have an issue, who have declared all their pseudo NPAs if the Supreme Court issue was not there. I think those are the ones to stick with.
Okay. Mr. Bagga, appreciate you taking the time out and joining us for this extended conversation, but it deserved it because the Nifty is indeed at 14,000. Thanks so much for joining in. Happy New Year to you.
Happy New Year, Niraj. Thank you.
Thank you. And viewers, thanks for tuning in. And to all of you as well, you couldn't have asked for a better end to the year, which has been anything but less eventful. But to all of you, wishing you a happy New Year.